Welcome to everyone attending this wealth management workshop as part of the 6th India Wealth Management Conference hosted by the CFA Society India. I am Saloni Sanghvi, founder of My Wealth Guide, and I will be moderating the first session of today's workshop. The fact that this workshop is happening so seamlessly online just shows us how ubiquitous technology has become in our lives, which leads us to the topic for today, platform as a service. Platform as a service, especially in the wealth tech segment, has enabled democratization of services in wealth management, providing a lot of small investors an opportunity they would have normally been excluded from, and enables large and small companies to access the markets quickly without having to build from scratch. In fact, it has been creating a lot of buzz lately, and just this week, Amazon made its maiden investment in the space. In today's workshop, founders of two leading platforms in wealth tech will take us through their experience with platforms and their remarkable journey, touching on the highs and lows and how they navigated these waters. Before I introduce our speaker, I have a few housekeeping notes. Today's workshop is scheduled for 120 minutes, including Q&A. Please ensure you mute yourselves and turn off your video cameras during the workshop. You can turn it on during the breakout rooms. The presentation will be, you would be able to view it after both the presentations conclude. The link will be shared in the chat box. Your feedback helps us with future events, so please complete the evaluation survey before you sign off today. Please take advantage of the opportunity and pose all questions that you have. We will take them at the end of each session. You can submit your questions throughout the presentation by clicking on the Q&A link at the bottom of your viewer and typing your question in the box. Post both sessions, the audience will have the opportunity to interact directly with the speakers and moderators, so make sure you don't miss that. And now it is my pleasure to introduce Vasanth Kamath, the founder and CEO at Smallcase, a fintech company based in Bangalore that builds simple and transparent investment products and platforms for the Indian retail investor. Smallcase has scaled to an investor base of 3 million plus and built an ecosystem with 250 plus businesses, including India's most trusted and respected financial institutions and brands in the last 5 years. Vasanth was featured in the Forbes 30 Under 30 list for 2019 and also awarded the Karnataka State Youth Award for Entrepreneurship in 2021. He majored in economics from IIT Kharagpur and enjoys reading, running, and studying business. Over to you, Vasanth.
Thanks so much, Saloni. Hello, everyone. Really grateful to the CFA Society for inviting me here. It's really great to be here, and hopefully looking to learn from you as well as share my learnings in my journey of 5 years as an entrepreneur building Smallcase. Is it possible for me to share my screen because I made a quick presentation here?
Yeah, Vasanth.
It just says the host is disabled participants.
Yeah, we'll just make it white.
Awesome, cool. I can now see it. I'm guessing you can see my screen now, and just looking for confirmation. You can see my screen right now, right?
Yes. Yes.
Awesome, great. So, like I said, the topic for the workshop today was platforms as a service in especially the wealth management space. So while I will talk about how Smallcase is a leading platform for a specific niche in wealth management, maybe I thought I'd start with talking about what a platform is, how at least we at Smallcase, or I personally think about platforms. It's a very used word. You can also call it an abused word. So there are many companies, businesses that call themselves platforms, but really aren't. So let me basically define what a platform is according to me, so that it's just a lot easier for everybody to understand what I mean when we are building a platform in the wealth management space. So starting with the definition itself, what's a platform? So many people talk about platforms as a portal, a property, a website, an app, anywhere where you can come in and access different services, products. But how, we, at least we think about platforms here is that there, it is an operating system for different businesses to connect with each other, or for businesses to, build their entire offering and services on top of. So it creates value for itself, but at the same time, it creates value for businesses that are operating on its platform. And in most cases, the value that, the businesses that are created on top of this platform, that's much, much higher than what the platform itself creates for, its own business. So I think it may be a little bit confusing in terms of, the words I'm using, but the idea is it's not just a website that has aggregated multiple products and services. That is an aggregator in my view, whereas a platform is someone who's actually allowing businesses to build on top of it and derive more value than the platform ever does itself. So what are, the characteristics of a successful platform, or any platform, for example? One is, it provides a toolkit for different businesses to plug into, and the degree of how easy it is to plug into defines, the success of that platform itself. The second is it facilitates connections for the business to connect to its customers or to its users. That's an important characteristic, again, of a successful platform. And the third one I mentioned, it creates more value for, the businesses building on top of it, or for the users plugging into their ecosystem, than it does for itself. So, we see multiple platforms out there. There are platforms that actually create more value for itself than people who are plugging into themselves. That will never scale as a platform business going ahead. That might be an aggregator, that might be a useful service for people, that might be a large business, but it's not going to be a successful platform or build an ecosystem around it. So these are, the three characteristics that we believe should be part of a platform. And there's a lot of thinking and philosophy that goes into building a platform, right? Like, for example, when we had to define, what the Smallcase platform would look like, we had to actually write a philosophy document, because as we, keep building a platform, especially in the digital or the technology world, what we've really understood is that there are so many ethics, morals, or, criteria that you cannot really you have to know from day one, as in you have to build this from day one. And while it will keep evolving, there are some boundaries, some lines you cannot cross. So it's very important to, have this philosophy document, or, having this manifesto right up front. So some of, the things that go into a successful platform's philosophy or thinking is that it should be neutral and an open architecture layer. And in terms of, the kind of services, the pricing, or the opportunity provided on the platform, it should be equal for anybody who's looking to participate. If you're discriminating in, say, either the kind of services you're offering, if you're discriminating on, say, pricing, you have one set of pricing for one set of participants on the platform, you have a different pricing for other participants or partners, or, the kind of opportunities that one partner gets versus another partner is different. It's not really, a sustainable platform or scalable system itself. So as an operating system, a platform has to be neutral and open, and should provide the same set of services, pricing models, as well as, the opportunity to all partners and businesses who plug into it. Many ways how platforms evolve, but then this, I've tried to kind of break it very simply into, 3 steps. It's obviously, it's too simple. It's really hard to build a platform, and these are definitely, a lot of defensibilities. It is, building a platform is a defensibility for any business, but then usually how a platform goes about building itself is, it starts from one side. It starts from a supply side or from a demand side. It provides value to that side. Say, for example, you start from the supply side to the supplier, the platform starts providing value, then the supplier can get individually. It cannot get access to, say, a set of resources, build certain functionalities or tools, or get some capabilities individually. That is what the platform will them. So it starts off from one side, it provides this value that the individual supplier cannot do on their own because of different reasons, be it just because of the kind of resources it has to build, certain features, capabilities, be it the kind of access it has because it's operating as a group or as an ecosystem versus an individual player. But it provides value beyond what one player on the supply or the demand side can do individually. And then it starts building the other side very quickly. As in, once you have the supply, if the platform delays in finding demand for that supply, it's not going to be a platform again. It's just going to be maybe a listing play where demand can come and find so many people listed. If say demand is built before say supply comes in again, demand is going to be disappointed. People will churn off. So it's very. This is also. The same dynamic that exists in a marketplace, but a marketplace is purely there to play a matchmaker's role versus just being a platform as well. So, these are all very interconnected concepts, but still how I think about how we think about a platform is that in addition to connecting users and, the suppliers or the manufacturers, I think there is a core value being provided by the platform to the manufacturing side as well. And so that's where the third step is to kind of build the demand side very, very quickly so that, the network effects, the flywheel actually starts kicking in. So maybe I'm just giving some examples, based on the three different parts that I talked about, maybe just some examples to understand what are platforms that we use in daily life, right? So if we look at, say, for example, e-commerce, now Shopify is a great example of a platform. One side, it started from the supply side. So from an evolution perspective, it started catering to someone who wants to sell online. So be it a merchant, now they work with sellers as well, or suppliers. And now they've even started working with large brands who completely use Shopify for listing their goods as well as all other tools and functionalities. What they provide to this supply side has been starting from, they started with a pretty simple storefront where a merchant could sell their wares. Then they provided inventory management, logistics connections, payment methodologies across different modes, analytics, so that the merchant can learn from what's happening on the platform on Shopify and actually do more business, select the kind of inventory they want to put up, etc. If say Shopify was selling directly to the user, which is what, say, for example, an Amazon does, right? Amazon provides all these services to a merchant or a seller or a brand, but they have a distribution property of their own. If that was true, I wouldn't really call it a platform. But Shopify here is actually not just that. It does provide a storefront, but it does not have, say, its own distribution. Even if it did, and if it was one of the channels, I would still call it a platform because Shopify plugs into so many other places. It's not just purely, if you're a merchant, if you go onto Shopify, if Shopify's distribution power or muscle is high, that's when you would get more business as a merchant. But that's not true for Shopify. Shopify has its own storefront, which then depends upon, you as a merchant, how much marketing or, how much of your network and community you can actually get onto your own storefront. It connects into Instagram and TikTok. So for example, there is a content creator out there who's talking about, say, beauty products. Now they can actually plug in your beauty product if you're a merchant for beauty products and actually talk about that inside Instagram or TikTok. They plug into an Amazon as well, which is where, say, there's already a lot of users using their Prime services or coming there to shop for products. So this is the traditional definition of a platform, and that's where the distinction I make with an Amazon, because Amazon is primarily, there's none of this. There is a storefront, but that's on Amazon.in. There's a, a distribution for them, but then that's built purely by Amazon. So Amazon kind of dictates the levers for how much you as a merchant will grow, which is not, a true blue kind of a platform play. Whereas Shopify actually connects to two different sides, and both sides can keep continuing to grow, indefinitely as well. Similarly, on the other side, now talking about, say, mobile apps, the App Store, or say, in this example, I've taken the Google Play Store. This is a great platform business example again. So you have on one side, product studios, app studios, developers, indies, people who are, just a one-man shop to start with, or even businesses who are actually building their business through the App Store. This did not exist, say, a decade back. So it's a very recent example of a platform, but there is an entire developer kit or an interface for someone to code out their app inside the Google App Store. After they publish their app, there's distribution not just through the Play Store, because that's where you find it, but then Google has really built their business around actually having more devices. While Google continues to monetize just from the sale of these devices, the larger play for them is actually distributing the apps or the Google Play Store versus actually their versus their own apps, so versus their own devices. Sorry. So it's not like Google always says Android phones is something that they will build, even though they own the Android technology. That's why they license out Android to so many phones, because their bigger play is actually taking Google Play onto more devices, taking the apps that their developer partners have built to more devices and more users, versus saying that they're in the hardware business and they're going to continue building the best phones. They basically license out Android so that the Play Store can exist on more and more devices. Now that started with phones, that goes to tablets, and it's just not again Nexus or Google's line, right? You have it on Samsung, you have it on Xiaomi, you have it on as many places as possible, and that's where it becomes a true platform as well. Here, say, like, let's take the example of again online video. If earlier you wanted to, for example, create some sort of music or video experience or content, you would have to join, say, a production house. Today you don't need to do that. You can just go onto YouTube. You can be a creator or an artist. YouTube caters to music labels. YouTube caters to businesses who want to talk about their products and offerings as well. So that's the creation side of things. It's debatable whether YouTube is really a platform, because most of its traffic comes from youtube.com, which is its lever. But then recently the embed functionality or people using YouTube's on their own websites and apps has actually started growing, which is a second channel of distribution. But still, it's I just put this example to say that YouTube is not a true blue platform in the truest sense of how a platform is defined. But still, there is there are these levers and dimensions coming in through which YouTube can actually not just or YouTube creators can not just depend upon YouTube to give them traffic, but also actually use the functionality of YouTube on their own properties, on their own shelf spaces as well. And what does YouTube do for them? This usually remains the same. It's basically a fulfillment of services, payments of services, the data, the analytics, all the tools required for you to build your business. So if you see in the previous one as well, you'll see, they provide you everything to create your app, distribute your apps, the payments for your app, the analytics for it. Even in the case of, say, a Shopify, it's the same thing, logistics, payments, inventory, analytics. So that kind of remains the same. Those are the services required to create this. But it's important that the two parts, of demand and supply are actually not just owned by the platform themselves, but actually can extend to, other integrations as well. I'll come to a couple of interesting things that come, but let me just come to maybe, the topic here. What are platforms in, say, wealth management, and why are they required as well? So, it's the same for many industries, but especially in wealth management, I think in India, if you look at it today, we are at an inflection point, as in, if you look at the number of people participating, the kind of amount or the allocation of assets in into the capital markets, into any asset class for that example, not counting bank deposits and cash. India is really low compared to any economy. So today we are seeing interest from consumers. We are seeing them actually allocating a lot more to different asset classes versus just keeping it in cash or in the bank account. So for that, to build that entire ecosystem around wealth, because all of us today as a ecosystem in wealth are actually battling one thing, which is people keeping their money in the bank account or cash, because today that's not the best place for someone to keep their money. So if it has to come out from there into different asset classes, instruments, options, products, you need an ecosystem to actually kind of keep building around. So that's some of the reasons that a platform is required in any industry. But for example, I'm just taking the example of wealth here. So one is it connects different participants in silos, and I'll just give an example of what's been happening in India without, say, a platform play really. You would have seen this happening multiple times earlier, that, say, I'm just talking about, maybe let's take the example of, say, stocks today. Now, say, you get research on stocks from different entities. You get transaction capabilities or execution capabilities from stock brokers. You get information data from, say, media properties, or say, for example, Bloomberg, a money controller, ticker tape, etc. And you get, say, advisory from investment advisors. Now, because these couldn't talk to each other, there was always a tendency for people to keep reinventing the wheel, which is, say, a broker would also provide information, would also provide research, would also provide advice. Say an information platform would start saying, I will start providing research, either editorial or, say, in-house research, or by aggregating research. They would start looking at how do we provide transaction capabilities. Similarly, you have advisors who started out saying we are a pure advisor, and then they started providing research, information, transaction capabilities. So, what is the downside of that? Maybe it's a good upside for the business that they're building, because you become a full stack player. But the downside of that is everybody's reinventing the wheel, and probably the core strength of a business is one, but they have to provide the other three, which might mean a substandard experience for the client. So instead of that, if you have a platform that connects different participants, whatever is happening in different silos, it's just more efficient for the entire ecosystem to actually focus on what they're doing. They have more mind share, bandwidth, resources to focus on one bit and actually grow that much larger than what they could with adding these ancillary or the other offerings that are not core to their to their business. That's one. Second is, obviously, we've seen this in different parts. Maybe I'll give some more examples in the wealth space itself, but it enables a lot more participation, and especially from new entrepreneurs who want to actually participate in this, but either the initial investment or cost is too high to get started. You have to build a team. There are licenses, etc. So a platform can solve a lot of the operations and investment requirements because they're already catering to 10. So all these value additions are happening at the center level. So anybody can come and start their business on the platform versus having to figure all of that out on their own. And the third is, again, very important in at least the Indian construct, is that whatever you have, say, for example, in wealth, again, now I'll take the same example of stocks. Today, if you look at the touch points for stocks, traditionally it has only been broking houses, right? Because the regulation or the compliance is such that you do need an exchange approved interface to place orders from, and that's what all brokers offer. But now, if there is a platform that or a layer that sits on top of brokers, that can be extended to beyond brokers. And that's how many investment or financial products have actually seen their day of light or become household brands, purely by saying it can be present on properties or apps or interfaces that are not just for built for that purpose. I'll give you examples in that, but what I'm trying to say is brokerages or traditional financial institutions have been started to distribute financial products, but the true growth, or you can see scale in these financial products only when you're capable of actually offering them on platforms and shelf spaces that are not only meant for this, because they're already catering to a large audience. If you can find a use case for a financial product to be offered to that audience without the platform being a stockbroker, that's when stocks could actually see its day of light. Or, for example, if we're talking about exchange traded products, ETFs. But I'll give you examples for all three of them, but just thought I'll mention why platforms in wealth management are more important, especially in the context of India. So let's take one of these examples, right? So what are we seeing? I'm giving both US and Indian examples, but more on the second part over here. How do we see new entrepreneurs or more participation coming in? So before that, I thought I'd just introduce what Smallcase is, because I'll be going into a little bit of Smallcase specific context. So we are today India's leading indexing and model portfolio platform. There are over 200 professionally managed Smallcase, 250 professionally managed Smallcases. We transact over $2.5 billion in transaction volume every year, more than 30 lakh investors, 150 plus distribution partners, 100 plus Smallcase manufacturers or index creators, and over 50% of new ETF folios and investors are contributed to the industry from the Smallcase platform. Just very quickly, if many of you wouldn't know what a Smallcase is, but a Smallcase is just basically a model portfolio or a transactable index for the Indian construct. it's a basket of stocks, very simply put, or the analogy I like to give is playlists for stocks or ETFs, right? So that you have a bunch of stocks or ETFs in any combination put together by a licensed professional, yet what's into that. So it's diversified by design. So a small case can have up to 50 stocks, ETFs, or real estate investment trusts as constituents. It's transparent and customizable. It's an open source structure. You don't get a unit of a small case. You actually hold the underlying stocks or ETF units in your own demat account. So you have complete visibility as well as you have control over the product itself. And there are no minimum thresholds, so it's ideal for individual investors to start small and SIP in towards the long term. Today, from a scale perspective, we are right now at 15%. So at 32 lakh investors out of 2.2 crore active demat accounts, 1 in 7 active demat accounts is on the small cases platform and investing in small cases. Yes, so coming back to the platforms in wealth management. So we are seeing this in India. In the US, we saw this not with fund managers, but actually with advisors, right? But maybe just give me one moment to explain the difference. I'll be using advisors very differently, from what investment managers are. I'm using fund managers in the context of manufacturers of products. So anybody who's creating a product, creating a model portfolio, creating a small case, creating a mutual fund index, these are all investment managers, fund managers, whereas I'll be using advisors in the context of someone taking a product to their client and advising them on how they should buy it. But that's what we're seeing in India today, that there are so many new emerging and breakaway fund managers that are coming through. We saw this, I think, maybe a decade back, where people left, say, the AMC industry and started their own PMS shops. Today we're seeing a resurgence of that, but it's not that they're starting PMSs now. They're starting their own investment management businesses on other formats. The same thing happened in US, I think, a decade back, where a lot of product distributors started becoming investment advisors. I don't want to get into too much of the details, but what the difference, I'm guessing what the difference between a mutual fund distributor and a registered investment advisor is. And for that to happen, like today, a lot of products are taken through the RIA channel versus the MFD channel in the US. And a lot of reasons sparked that, right from investors' behavior changing. They were more aware. They wanted to understand how they were investing, incentives, commissions to be aligned, etc. All of that. But then for that, you really needed platforms to play the role of enabling this to happen. So this was the platform in US. This is called InvestNet, that actually enabled this whole, was a big reason for people to be able to shift from mutual fund distributors to RIAs who are taking ETF model portfolios to their clients. So what does InvestNet do today? While it provides infrastructure for, or the platform for ETF model portfolios, that's their core business. They have now started diversifying their business. They also own Yodlee. I don't know how many of you know Yodlee, but any interface between your bank and any other app that wants data from your bank, most of them really use the Yodlee API. So InvestNet has acquired Yodlee. I think the company name is also called InvestNet Yodlee. It's a public company, so a lot of literature and information is available about it on the internet and on data platforms. But what InvestNet, they started doing was, on one side, they got manufacturers, right, like be it asset managers, research houses, and fund managers, to create portfolios or wrappers or say strategies using ETFs. On the other side, they enabled advisors and wealth platforms to take these model portfolios to their end clients. And what InvestNet handled was the transactions, the reporting, the payments, the analytics part, like any other platform does. But then this helped a lot of people get two things. One is the infrastructure layer to start their own RIA practice. Second, the product layer also, because when you're doing a mutual fund earlier as a distributor, there are many ways in which the exposures are taken care in the mutual fund product itself. The mutual fund product isn't transacted on the exchange, so you don't you can hold it in a physical format, in an SOA format. So that was a much easier way for people to do mutual funds. But when it came to ETFs and RIA models, you needed a platform in between to actually do two things. One is provide all these value-added services to the advisors. Second, actually provide the products as well. That's where, say, InvestNet went to a BlackRock, a Vanguard, a Fidelity, said, instead of just giving single individual ETFs, let's get these ETFs bucketed into different portfolios or strategies. They then went, which was the supply side. Once those products came in, they went to advisors and said, these were people who had just started their RIA practice because they felt that would differentiate them, and they said, you need products. Why don't you start taking these from the same brands and manufacturers that you've been taking mutual funds from? So that's where trust, credibility, as well as the base platform was provided to advisors, and today it is the leading advisors platform in the US, where still a lot of them actually use this investment platform for both products as well as the infrastructure. Today, we are seeing a lot more, disruption or innovation happening in this space, where it's moving, like what moved from mutual funds to ETFs is now moving to something called direct indexing as well, which is portfolios of stocks. But there we are yet to see any platform play in the US. I think, in that respect, India is actually ahead, but there we are seeing, a lot of manufacturers or people who are creating these stock portfolios, and on the other side, aggregating advisors. So I wouldn't really, again, put that into a platform play, because they're only taking their own product to advisors versus, say, an InvestNet, which is enabling, any product manufacturer to create a new set of products and actually take it to clients. The second example here is what's happening in mutual funds in India, and StarMF is a great example of a platform business, right? As in, on one side, StarMF has empaneled or integrated with all the AMCs, gotten all their products onto one platform. They've integrated with both the RTAs so that they have coverage across all products and AMCs as well, and it does provide the same set of services to anybody who wants to plug in, and that's either, say, the transactions, the reporting, the payments, the analytics, everything that an MFT or an RIA needs to actually build their business. And that's why today, if you see, StarMF really rules the roost in terms of number of mutual fund transactions happening in the country, because they started this very early. I think it's been 10 to 11 years now that they started their business, and again, they started it out from a very specific use case. They started building it for MFTs. They didn't have the supply side in order first. They said they went to one. In terms of the evolution that I talked about, they went to one mutual fund distributor, said, okay, which products do you want? Started aggregating products on the other side, expanded on the MFTs, started expanding on the asset managers. And today, a new asset manager comes in, they plug into BSE StarMF, a new RI or MFT comes in, they plug into BSE StarMF. Along the way, they started working with, say, brokerages and new fintechs, and which is where they are still continue to be the market leader in terms of processing or facilitating mutual fund transactions, the maximum number of transactions in the country still today. Now it's a little bit of plugging of what we do at Smallcase, but that's what I'm coming to, where it's a mix of what we're seeing in the US. Small cases are baskets of ETFs as well as baskets of stocks. So, for both stock and ETF model portfolios in India, we provide a platform on both sides, right? So we have investment advisors, research houses, investment managers, portfolio managers on one side, creating these model portfolios of what we call small cases. We provide the entire set of functionalities, from onboarding clients to transactions, to reporting, to compliance, to payments, analytics, invoicing, communications. All of that is provided by the platform to these manufacturers, and this is taken to the end investor or user through different channels as well. Broker partners take this to their end clients. We have digital wealth platforms, for example, Akoera, taking this to their end clients. We have individual IFAs, over 500 of them, who are actually empaneled onto the Smallcase platform, who take this to their end clients. And both sides will continue growing. So, for example, we launched the Smallcase publisher platform. We call this the publisher platform in March 2019. So I think 2 years, 1 quarter from where we are today. And from one manager, today there are 130 plus managers on the platform. From one distributor 3 years back of small cases, today there are 150 plus distributors of small cases, taking these products to their end clients. So this is, again, a classic case of a platform, because while there is a small case app element to it, but that is not the only channel. We are continuing to add more channels, be it in terms of IFA networks, be it in terms of banks, neobanks, loan distribution platforms, insurance distribution platforms. So this part will keep continuing to grow. on this side, more and more managers are coming in to actually create small cases and different types. I'll just go into that very quickly, but why this is happening, a lot of know what's happening with the product layer part in India. Small mutual funds are becoming a lot more commoditized, restrictive, and it's moving for new investors coming in. PMSs are becoming very expensive for both someone to start a PMS business. The minimum ticket size for an investor, while it's at 50 lakhs, but the net worth required to start a PMS business is at 5 crores. So it's getting tougher for people to build their own investment management business in either the AMC or the PMS side. For an AMC, you need 100 crores of net worth, or you work at an AMC for a couple of decades. For a PMS, you will have to have 5 crores of net worth. So a lot of new emerging managers are choosing, to become an RA or an RIA. The net worth requirement is as less as 5 lakhs, no minimum ticket sizes, and the Smallcase publisher platform allows you to basically start building a business without any initial upfront investment or cost. So that's where, small cases are filling this gap in the product layer. I talked about publisher, but very quickly going through it, we like to call it a Shopify equivalent for fund managers, but it provides all tools, functionalities to start, run, and grow your investment management business. Today, like I mentioned, we have 130 plus small case managers, some of whom are also on this call, but it's a mix of both people, who have been doing this in other formats, choosing to start with the small case format. Also people who want to tap into retail today, people who want to, advise on ETFs, have interesting stock portfolios to create, want to basically launch a product very quickly. So, there's a whole set of established as well as emerging managers coming into the fold, and that's where we're very proud to kind of have the platform to actually enable them to launch their business and continue growing. Moving to the next part, which is the product distribution layer is really exploding, and that's also been a very important reason as to why we are seeing so many new participants or so many new investors coming into access different asset classes. And I'll not just talking about equity, but generally any financial or investment product itself. The distribution layer is exploding. Now, say there are many different ways to actually attribute this or understand what the trend over here is. But say one of them is a lot of new brokers coming up, brokers innovating on the price structure, the fee structure, the kind of experience, the kind of ease of onboarding, all of that. There are so many new brokers that have actually enabled better access for many individual investors. But now, say people talk about Robinhood or many Indian platform, many Indian apps also as platforms. But are they really platforms in the truest definition? On one side, you have products, you have stocks, you have options, you have ETFs, you have crypto, you have different asset classes that they're aggregating on one side. But are they really connecting to different businesses to take this to more places? And that's where it becomes very unsure whether Robinhood is really a platform for financial products or a platform for distribution platform for financial products, or is it just an aggregator of financial products and it has a really good UI and really good experience for its investors? It does what it's supposed to, but for its customers, but there's no business angle to it as well. They do mention they have an API, but maybe that's only with say 2 or 3 trusted partners that they work with. But other than that, it's not really democratized or actually increased participation or some of the elements that we talked about for a successful platform, right? It's not really been following those. Hence, while it's creating a great experience, maybe a great ecosystem for people, but it's not really a platform. It's just maybe an aggregator of financial products. One of the platform plays again in the US. India doesn't have such a similar equivalent, but you have a broking as a service, called Apex Clearing. I think it's just went public through a SPAC kind of model. So, there's a lot of documentation out there about it. But what Apex Clearing does is it connects to the exchanges on one side. It provides, clearing services, custody services, back office, front office, integrations with, say, a platform like, InvestNet, etc. And any robo-advisor like a Wealthfront used to use Apex Clearing. Brokerage today, a Stash, earlier a Robinhood used to use Apex Clearing. A lot of fintechs like say, Square, Sophie, etc. actually use Apex Clearing for its backend processes. Not all of them use the same set of services, but some of them use just the custody services, some of them use clearing services, etc. But this was, and again, a much quoted example for a platform. To some extent, yes, because it is enabling more participation. It's offering a core set of services or value to certain businesses who will see more value being created for themselves versus Apex Clearing itself. And it has been a neutral open layer in terms of providing the same set of services to all businesses that want to plug into it. So it is a platform. I think what I'm trying to get to is a true platform in this side would be, because Apex itself is a broker over here. A true platform would be someone who connects to multiple brokers. So you're not just stuck with one broker's experience. So here the risk, or say the tipping point, comes in if Apex is down on one day. All of these services start not functioning very well, which is where you see a Robinhood moving away from Apex Clearing, because they say, I'm dependent, their core business is dependent on a service that could go down. Say robo advisors, you have a wealth fund that's built their own clearing house eventually, because they don't want to be dependent upon just one clearing house for their entire operations. A more democratized, a more platformized way to actually build this is what we have done with Smallcase again. So at Smallcase Gateway, instead of us being a broker, we basically integrated with the largest 15 brokers in the country. They cover like 95% of all demat accounts, and we provide the same services that a broker's API integration would. So Smallcase Gateway has transactions for both individual securities, individual ETFs, or basket orders for stocks and ETFs. You can import holdings of a client through the Smallcase Gateway with client consent, obviously, and you can even enable new accounts to be opened with these brokers through the Smallcase Gateway. And that's where, say, this has seen different use cases like digital wealth platforms, fintechs, media content plays actually using this to offer transactions on stocks and ETFs on their own properties, right? So here again, this why I'm saying this is more of a platform than what Apex Clearing is because this is not, again, just one principle on which everybody is depending upon. There are 15 brokers on the other end where, if one broker is not working, still there are 14 other brokers that are working. So the risk of, the platform not operating as intended goes down when you have more parties on each side. So this will continue increasing, where we'll continue to integrate with more brokers. This part of who is taking these integrations to their end clients will continue increasing. We're finding more and more use cases, but this is, an ideal example of a platform that's offering broking as a service again, because it's not just one broker, but multiple brokers on the other end. So just, continuing about why we see this as an important piece in financial product distribution or in wealth management in India is we are, seeing, like I mentioned earlier, a lot of new platforms actually offering financial products, right? And this is not the traditional ones. You're not seeing just say NBFCs or distribution houses or wealth management players offering financial products, but you're seeing mobile manufacturers. And Oppo has launched its own mutual fund distribution, its own broking. Xiaomi has launched, credit. It's piloting mutual fund distribution. So they are offering financial products to their end clients. Payment apps obviously started with payments, but today all of them are participating in wealth, assets, and investment products in different ways. Google Pay started gold, Amazon Pay started gold, Paytm has become a broker, PhonePe is becoming a broker, MobiKwik has started offering mutual funds and bonds as well. You have platforms and apps with large user bases, but are not connected to the financial services space in different ways. You have Flipkart offering insurance, you have WhatsApp starting to offer micro insurance, micro pension products. You have Cred. Yesterday they launched a P2P lending product, but before that they started off doing tracking of mutual fund assets and eventually transactions as well. So there are a set of new apps and platforms with large user bases who are adding financial or investment products purely from us to monetize or to engage their user bases better. And that's where, say, these platform kind of solutions or API-led neutral solutions have actually gained. So if you look at digital gold, there's one player that was launched in 2014 that has 75% market share. And that's who Paytm, PhonePe, many of the apps like Google Pay, etc., who's offering digital gold actually connect to. You have for mutual funds, the Star MF, I talked about it, 80% market share in transactions, great success story. Now it's been 12 years actually, but they connect to a lot of, these new apps at the same time, obviously, both traditional distributors as well as brokerage houses. And then for exchange traded products, be it stocks, ETFs, or small cases, that's where, the Smallcase Gateway comes in. We just launched this last year. And today we're already working with, a variety of use cases. But again, the core idea, or where the seed came from, is if broking houses are only going to be responsible for distribution of stocks, ETFs, or exchange traded products, you are always restricted in terms of the addressable market or who can actually access this. But the kind of use cases that we're working with, be it a money control, where you can transact when you're looking at information, be it a Kuvera, which was a mutual fund first platform, now has multiple asset classes, of which Indian stocks and ETFs is one. IFA platforms, payment apps, working on say use cases like gifting a small case, gifting stocks, people using it in their newsletters to enrich their content, to enable transactions, people using it to actually import their holdings. So a lot more use cases are possible because there's one neutral layer that builds this on top of brokers, but those use cases actually deepen the distribution and access of exchange traded products to end clients. And some of this is also going to be the reason where we are going to see a lot more demat accounts being opened, because it's just there is obviously a market evolution, but a lot of these use cases actually fast track or accelerate the entire process of more people participating into the exchange traded products side of things. So this is what I had. Hopefully, it's been interesting from both a content and a learning perspective. Very happy to take questions, or if you want me to go deeper into any topic, happy to do that as well.
Thank you very much, Vasanth, for that insightful presentation, and some great examples to also understand platforms versus marketplaces, aggregators, etc. Just a reminder to all the participants, you can submit your questions through the Q&A link at the bottom of the screen. So Vasanth, WealthTech is actually expected to grow threefold from $20 billion today to $63 billion in FY25. Platformization is threatening traditional wealth management companies by filling in certain gaps. Do you think there's space for both models to coexist concurrently, or will it be eventually adapt or acquire?
Sorry, I didn't get your question, Saloni. Can you just repeat the last part?
Yeah. So platformization is threatening traditional wealth management companies. Do you think there's space for both models to exist concurrently, or will it have to be adapt or acquire?
Sure. No, I think great question, because this is something that I keep seeing a lot of people actually trying to understand. So, and I think that's what we're seeing, right? Or at least what I explained in the presentation as well. Now, would you call a digital platform offering products a platform, or just another way to access these financial products? So I wouldn't call them actually platforms, because they are catering, maybe, as an example, let's talk about, say, traditional wealth management versus a new, digital wealth platform, right? So this is, I'm guessing this is the question where you're saying, will they compete, or will it be, an acquisition kind of a thing? I think these two are competition, in the sense they are never going to kind of, do things together. But where the role of a platform comes in is where someone comes in to actually streamline or offer the same kind of experience that a digital one can, because they built it from scratch. But say, a traditional wealth management can't, because they have issues of legacy, they have their own baggage, they have their own older systems and software that they connect to. So that's where, both, if you see today, even how, a lot of the digital wealth management platforms have built themselves, while on the front end they have built their own experiences, and to their credit, super simple experiences, great way to access the experiences, the UI is great, you get all the data, the reporting that you're looking for. They're all really built on platforms at the back end, which is what, say, these platforms weren't available earlier to a lot of these wealth management firms, which is where they had to build this more manually, or through a human in the loop process, or directly connecting, which today is a lot more inefficient, because earlier, if without say a star MF existing, someone had to actually go and empanel themselves with every AMC, right? And that brings a lot of inefficiency into the process. Whereas say today, if you look at any digital wealth management firm, they connect to all AMCs via the BSc star MF, and that brings a lot of efficiency. So I think the question here is more around everybody, like the new players are actually adopting platforms to one, provide a seamless experience, because the front end is what matters, or the client experience is what matters. Whatever happens behind is fine. And the second is to actually launch more offerings faster. These platforms help in a much better way, whereas the traditional ones have actually built their own pipes, and that's where there's a lot more maintenance, patches, all of that required to actually keep the system running, which is where it diverts focus from actually the client experience, or launching new offerings, or providing more asset classes, more products on their platform. So I think that's that requires a mindset change really, because earlier these platforms didn't exist, hence people had to build it, right? So but now, given the platforms exist, there are so many models, so many ways to engage and collaborate with these platforms, that it's never going to be whose users it is, etc. These platforms are always going to be a plug and play way. They are continuing to basically be neutral, be more of a B2B player versus eventually take their market share. So I think it's just everybody has to realize that and figure out how to work with platforms versus say that we will build the backend part completely ourselves.
Right. It's interesting that you mentioned that. So, as a manager on Smallcase, I definitely see the advantages of Smallcase for myself and clients. But as you mentioned that, a lot of brokers and wealth managers have legacy systems. Now, you've tied up with some of the largest names actually in the industry. So what kind of resistance did you face, when you approached them?
Sure. So, for example, the first set of participants in the Smallcases ecosystem were the brokers, because if we didn't have the transaction platforms, I think it would have been very tough to get, for example, you as a manufacturer, because if I had one transaction platform or two transaction platforms, it might be worthwhile your effort as your own enterprise to actually go and integrate with those two and even more. But that was the first thing that we needed to, which is increase coverage of demat accounts who can actually transact in Smallcases. So there, again, I don't see it as more, it was definitely a long sales cycle. Took us 1.5 to 2 years of meeting us, pitching, articulating what our vision is, etc. And I think a couple of reasons where it was very tough for people to understand. One, there was no precedent, right? There was no precedent of something like this in the in any market. So if I had, for example, this was happening in the US, I could have actually taken that model and shown people that this is happening in the US. Hence, this is a way that this will evolve. So people want to understand, what happens 5 years out. They want to understand the risk. They want to understand the advantages. So if it's already happening on the market, it's much easier to articulate that story or for people to get it. So one, there was no precedent. Second, at that time, there was, not the kind of collaboration or convergence that we're seeing today between financial services and fintechs, right? So that this was 2016, 17. So very new at that point to actually, go and pitch something like this. The third, once, we got them over the line, got them convinced, got them bought into the vision. The third aspect, which was challenging, was the actual integration aspect. Because again, it's not like every broker has built, a very modular, flexible system that anybody can connect into. This has happened over decades. Many brokers have built their own instances, their own versions, their own variants. They have vendors building different parts of it for them. So it's like, it's a huge system that's just being built for their own purposes versus actually being built in a way that any other player can actually connect into them. So that was the most challenging part in terms of time. Took like till today also, like a lot of people ask us, why is this large broker still not on your platform? Why can't we transact Smallcases? We have actually partnered with all the brokers, but it takes us anywhere from 6 to 8 quarters to go live with one broker. And that's because there are custom pipes being built for this integration. There's an approval process, etc. All of that takes a lot of time. So I think first it was getting them on board with this vision where without a precedent, without this whole convergence happening, it was even more tougher. Today, I'm hearing, say, for example, someone wants to go and offer bonds in a way that we have done with, say, equities to different brokers. It's much easier because they know that this is the way to go about it. The discovery around what should be the commercials, the legal, all of that has become much more easier. So, those players are finding it much easier to do the convincing part. Obviously, the integration part is still as complex, but those were some of the challenges that we faced when we spoke to the industry.
So we have a question from Bihari Lal. What are the data security issues for a regulated entity to host client data on their platform? And how do you mitigate it?
Sure. Thanks, BD, for this. I think there are data security laws and provisions that every business should look at, especially in the financial service space, because the sensitive data, it becomes even more important for any business to actually have these practices and keep very high standards. How we look at it in Smallcase is that while things are being stored on our servers, but it's on behalf of the participants that are plugging into these ecosystems, right? So it's not really our data, it is their data. And at some point, we also believe, how we have actually architected systems. This is going to come into action very soon, where the Data Empowerment and Privacy Act, etc., which puts the ownership and ownership of the data back into the user's hands, because it's their data finally. Obviously, there's some guardian for it, which is, say, if an investment manager is providing a portfolio or a small case to their clients, they need to have certain data in order to continue providing those services. So that's where it's shared. But then what we do is basically store that data on behalf of both. And if, say, tomorrow, for whatever reason, the investment manager decides to turn off the platform, we delete it from our servers and actually provide a dump to that that professional who's on the platform. But from a security perspective, there's obviously a lot, and I think it's never going to be 100% or even 95%. New things keep coming up every day, so it's just there is a security function at Smallcase that just focuses on keeping both transactions data as well as the system security up, robust, and very, very safe.
Right. So we have a question from Shimul. In financial statements, XBRL standards are being adopted for standardized tax statements. Do you see similar initiatives for financial products? Essentially, she's asking about standardization of financial products.
Sure. So in terms of, I think there's a lot of standardization happening on the data for sure, right? As in the AA framework coming in, DEPA, Sahamatis, Collective, etc. So both financial, users who want this information, as well as providers, have to stick to a certain standard. And I think that's happening for many, many different offerings, products, services, whenever there's a platform in place there. So earlier, for example, when I mean earlier, I'm talking just 5 years back, where you wanted to do payments. It was simple for you to do a payment with someone who had the same bank account, an account in the same bank as you, because that was an interbank kind of transaction. So you could download the banking app, you can maybe just put in the number of that person and actually transact. And that's again a very good experience that used to be offered 5 years back. Today, if you look at it, UPI has actually come and standardized the entire offering again, because they have gone to every bank and said, let's have a standard set of requirements for every account, every payee, every beneficiary, so that people don't need to keep adding the NEFT, RTGS, IFSC codes to every transaction, making it a much larger thing. Now you just need, it's abstracted out everything. It said you need that UPI ID or that VPA, so that everything else falls into line with that. So now, for example, that's happening with, say, demat account information, because at Smallcase, we are integrated with every broker. We understand the use cases on the other side, what a Kuvera wants, what a Money Control wants, what an SBI MF wants, and hence we are able to standardize what's happening on, say, any exchange traded product information or data. The same thing has started happening with mutual funds, where say Star MF plays that role, RTS plays that role. So actually, this is a great question and linked very much to the presence and thriving of platforms in this space, because the more the platforms that come in, you need to start standardizing stuff on both ends, the supply as well as the demand end. So it is happening different phases. Now, say you have the OCEN APIs, which is that open credit enablement network. So for loans now, there's a standard in place. So across every financial product, it will happen. I think it will happen in India much before it happens anywhere in the world. So I think, this is an eventuality and inevitability, but happening at different rates and paces across different products.
Yes, I completely agree with you. I think the regulators also have been very active in the space, ensuring standardization of products and reporting standards as well. So Anil has a question. Anil has a question on how does the rise of neobanks and digibanks mean for platforms like Smallcase?
Sure, Anil. So I think they would form one of the distributors for, say, small cases. It's not just neobanks or digibanks, it's any bank without an embedded securities or a brokerage arm, right? Because more people want access to stocks, more people want access to ETFs. There are interesting products and exposures coming out with stocks and ETFs. Earlier, like what I mentioned in the presentation also, Anil, that this access or transaction capability is only restricted because you could only do it on a broking platform. But now, given that we've been able to abstract that complexity or that compliance, get it into an API layer which can sit anywhere, a neobank can now offer a small case transaction, which just increases the distribution potential. Say today, an IndusInd Bank doesn't have a tie-up with any brokerage arm. We can partner with them to basically say, let's have small cases, stocks, ETFs on your portal without you having to build a brokerage. And what the gateway has done is what exactly payment gateway has done to say, digital payments or UPI has done. Earlier, if you needed to pay, you would have to, go to your bank account, add someone and then pay them. But say with a payment gateway, Zomato is not a bank, but it can accept payments very easily and do the entire thing without having to say, oh, has the payment come in, add my beneficiary, this, that, etc. That's what used to happen like, a decade back, actually, right? You had to, even if you're doing an online transaction, you had to add someone. Even if it was on, Flipkart, there was a time when you had to add Flipkart as a beneficiary and actually pay them versus a payment gateway kind of a thing. So the same thing is happening with, investment products. Smallcase Gateway is doing it for stocks, ETFs, Star MF is doing it for mutual funds, gold APIs are doing it for digital gold, etc. So the rise of, say, neobanks or digibanks essentially means more distribution properties, more access, and hence they will leverage, platforms like Smallcase or Star MF to actually provide those products to their end users.
Vasanth, you'd mentioned that basically RIAs, RAs, portfolio managers, etc., can onboard on Smallcase. Vijit wants to know how can a platform maintain quality of genuine buyers and sellers? How does Smallcase ensure that only quality fund managers are on the platform?
Sure. So again, this is a classic, platform versus aggregator versus, say, distributor kind of question here. Thanks for this, Vijit. I think here, if you look at it, we will never, say this fund manager cannot come on the platform, because if that is happening, then it's not really a platform, then we're a distributor. Like today, if you look at, say, let's take an example like Kotak Securities, right? They show 20 small cases to their clients. The entire catalog is 250 small cases. But if they're showing 20 small cases, that means they are taking a call on different parameters, be it diligence, be it their own criteria, be it, some economics related discussion, but they are curating a set of small cases to be shown to their clients. If that is happening, it's not a platform anymore, because, then you are an aggregator, then you're a curator, then you are, providing this, you're a shelf space, but you're not a platform anymore. So I think how this will actually evolve for platforms is it's similar. Like let me just give an example of, say, a Spotify. Spotify is a great platform for music, podcasts, etc. But now if Spotify says, oh, your music is shit, I'm not going to allow you onto the platform, that doesn't make sense. That decision or that data or that curation has to come in from participants in the platform versus the platform doing it themselves. So what we want to do, say, on the platform is start having ratings or some sort of feedback for every manager, every small case. And this will come from people who've invested into it. This will come from the system where, say, for example, there was a rebalance expected on this date, but the manager did it 2 days later. There should be some way to actually show that this was not being followed by the manager. So both system driven feedback as well as user driven feedback will actually give this as an input into every manager. But I don't think as a platform we'll ever say no to someone. If they're not licensed, sure, yes, then we have a credible reason to say no. But otherwise, as a platform, we'll continue onboarding managers, but will continue providing or adding more inputs or data or feedback so that people can take better calls.
So I think we have time for one last question because the next session will start soon. So Vasanth, in my experience as a wealth manager, I've seen that even the most savviest investor still prefers hand-holding, especially when it comes to managing their money. Is customer service a challenge for you because you're largely a digital platform, with people wanting to speak to someone in person and understand the process?
Sure, Saloni. I think, I don't know how it defines savvy, as in I know the regulator has a interesting way to define savvy, but, if you look at the wealthiest of clients, they need handholding, not because of the fact that they don't want to understand, they don't have the capability to understand or anything, but just purely because of the fact that they don't have the time to basically put into it. This is true also for the lever that you mentioned, which if somebody is coming new into the markets, they want a certain bit of handholding. The third thing, actually, that's a behavior here, and what we're noticing more and more is that the newer set of people, the younger people, do not want any handholding. And this is not to say that they know everything, hence they have the capability, or they have this, they are savvy enough to understand, hence they don't want handholding, but they want to take decisions on their own, be it right or be it wrong. And we're not just seeing this in investing or wealth for that matter. We're seeing it across everywhere. That they want to be able to be in control, take their own decisions. Even if they may be wrong, they will learn from it, and tomorrow, they will maybe rectify, they'll correct it. But they still want that, that optionality of control is very, very powerful and important to them. So then that's where, digital first platforms, which give the entire decision-making power to that investor or to that segment, is actually growing, because these people are coming into the markets much faster. But to answer your question on Smallcase, it's not purely digital, right? So there are DIY or digital workflow is one of them, but the platform also supports, say, assisted buying or investing workflows. For example, today, if you look at, say, certain brokers where we have a front line, where we have a sales force, their relationship managers, their branches, their what do you call that? The dealers, they are all hand-holding the customer in different ways. They can place the orders on behalf of the customer. They can initiate the trade. They can send a link and actually, nudge that investor, or they just basically say, go here and place this order. But that's what there is also this kind of workflow supported on the Smallcase platform. But as we are seeing, that is becoming much lesser and lesser, because one, it's from a business perspective, it's cheaper to obviously help the investor do it DIY. From investor perspective, this is changing. Like, classic example, my dad itself, like 3 years back, he used to call and trade, right? And then he didn't like that process for multiple reasons, but it was convenient for sure. But he didn't like it because you're telling your strategy to someone else, you're discussing it, there's some judgment, all of that happening at the same time, so many things happening together. Today he just does it himself because it's much more convenient, efficient, and he doesn't have to worry about it. There were other regulatory reasons for which this had to happen earlier, be it cash settlement, etc. But today all of them are gone. So I think more and more people are becoming digitally savvy, but the platform, for your question, still continues to cater to assisted and handheld workflows as well. It's not just purely the digital work.
So it's a great combination of a hybrid human plus digital model, essentially.
Absolutely. We have the workflows required for distributors to kind of track their business, take initiate transactions, take links to their customers. Dealers can place orders with verbal confirmation from the client. So all of that is available on the platform.
Great. I think that's all the time that we have for today. But please ensure that all of you stay back after both the workshops or breakout sessions to interact with the speakers and the moderators. Thank you very much, Vasanth, once again for taking out time to share your insights and to everyone that's tuned in. I'll now hand the mic and the screen to Shagun Tukral for the next session.